Please, Tony, your 7 minutes start now.
Yeah, thank you very much. So I'd like to talk to you today about US senior loans. We actually think they're a very compelling asset class in the current market environment. And before I go into why senior loans make a lot of sense, I'd first like to give you a brief description of the asset class. So on slide 3, the first thing I would like to, and do we have the slides up? I can't see them on my side. Yeah. Anyway, so on slide 3, just what are senior loans? So senior loans are loans issued to companies rated below investment grade. So think of them as similar to high yield bonds. Now, there are a few features that are important to point out. So the first thing is that senior loans have a senior secured status in a company's capital structure. So in the event of a default, senior loans holders of senior loans actually have priority of claims on the company ahead of high yield holders and common stock. In addition to that, their coupons are actually floating rate and they're tied to the secured overnight financing rate, which is basically the federal funds rate. So on a monthly and quarterly basis, depending on where short-term interest rates are, the coupons on these senior loan floating rates adjust accordingly. What does that mean? They have very, very low sensitivity to duration. So the typical duration of senior loans is 0.25 years. That compares to high yield of about 4.5 years, and investment grade corporates closer to 7 or 8 years. So that's quite attractive. This is a large asset class. So today, senior loans are about 1.4 trillion in size. And just to give you a sense of that, it is 3 times the size of the European high yield market and the same size as the US high yield market. Now, what are some of the companies that issue in the senior loan market? I'll give you 2 examples. Charter Communication is one of the largest providers of broadband and cable in the US, 30 million customers over 40 different states, right? These are very large companies. Bausch and Lamb is one of the world's largest suppliers of contact lenses and eye care, medications. So really big businesses. Now, some of you may have heard of private credit or direct lending. So private credit also has the feature of senior secured and floating rate. There are 2 important differences to point out between senior loans and direct lending. The first is that senior loans are actually issued by companies with earnings, pre-tax earnings of usually $1 billion plus, right? So much larger versus direct lending where the typical company has, say, 30 to 100 million of EBITDA. The second thing is liquidity. So in the typical direct lending fund, you have a 7 to 10 year lockup. Senior loan funds usually have daily liquidity or sometimes weekly, but they're nonetheless much more liquid in terms of investors' ability to invest in and out of the asset class. So if we move to the next slide, why is this attractive? I think I pointed out a little bit earlier. The first one is this floating rate income, which means that you are protected from changes in interest rates because the coupons actually reset every time rates change. The second thing is this senior status, right? So if you think about 2024 and afterwards, we're getting to the end of an economic cycle and you're likely to see a global slowdown. You want to make sure that you're up in the capital structure of companies in the event something goes wrong. And we always have to think that way as fixed income investors. You have, senior status versus other, debtors or equity holders of a company. And then the last thing is the security. So your holdership of the loan is actually backed by collateral, right? So you are a secured lender. You have the ability to actually put a claim on the company. And as a result of that, historically, senior loans have had a much higher recovery when there have been defaults relative to high yield bonds. We think that makes it a very attractive asset class as well. So if we move over to the next slide, so how do they differ from traditional bonds? let's think about it in terms of changes in interest rates. So typically when interest rates go up, because senior loans have very low duration, their price stays very, very stable, right? If you compare that to your typical bond, when interest rates go up, you have pretty significant price declines. You could think about 2022, when traditional bonds were down 11%, senior loans were actually significant outperformance in that market. And then the second part is in terms of income, when interest rates go up or down, because your coupon is tied to short-term rates, you have income move up or down, again, based on what short-term rates are doing. Now, our view is that the Fed is going to keep rates fairly elevated for a long period. So if your coupons are actually going to be quite high, over the next kind of 12 to 18 months, we think senior loans make a lot of sense as an asset class. If we move over to the next slide, in terms of risk and return, what we've done here is basically show you all the kind of major asset classes. The left is, the left axis is the 10-year return, and the right is 10-year standard deviation, right? We're using volatility as a measure of risk. And what you will see is that on the very top, you have US senior loans circled in red. Very, very attractive returns. They've actually, over the 10-year period, generated almost the same returns as US high yield, but with less than 50% of the volatility that high yield has had, or just slightly over 50%, right? So loans have had 10-year vol of 5.5. High yield 10-year vol is almost 8%. So definitely a very attractive asset class, and one that investors should pay attention to. The other thing to point out is today loans are yielding somewhere in the 9.5% level. We think that's actually quite attractive, and our target is that in 2024, you can look at total returns somewhere in the highest single digits to low double digits for this asset class. It's very, very compelling for investors. If we move on to the next slide, one of the objections we usually get is, well, senior loans only make sense when interest rates are rising because you benefit from that coupon bump. What we've done is basically look at periods of rising interest rates and falling interest rates using price returns of a 10-year US government bond. And what we noticed is, unsurprisingly, if you look at, for instance, on the left, global bonds, global corporates, US treasuries, these are very interest rate sensitive areas. And so they've done poorly when rates have gone up and better when rates have gone down. Now, in the case of senior loans, we argue that this can be a strategic part of a client portfolio because they've actually generated returns in both rising and falling interest rate environments. And the numbers you see there are actually average monthly returns over a 10-year period for all the asset classes. So we really like the fact that both in rising interest rate and falling interest rate environments, senior loans present a lot of value. And then finally, on the next slide, in terms of the case for the asset class, I'd like to point out that if you have a global aggregate portfolio, right, today it's yielding about 3.5% with a 6.6 duration. If you add 20 or 30% exposure to US senior loans, what you end up getting is actually a very attractive profile. For instance, if you add 30% theoretically to a portfolio of global aggregate, you will get a yield to worst of somewhere in the 5% range with duration less than 5 years, right? 4.6. So as investors think about ways to generate income, generate competitive total returns, we think loans are actually a very viable alternative to consider. Then very quickly to slide 10, one of the ways to access...
Sorry, Tony, I remind you, time is almost up.
Sure, yeah, I'll finish very quickly. So Nuveen manages 17 billion in senior loans. That's a part of our 40 billion leverage finance platform. And that makes us one of the largest investors in the space, with tremendous access to management teams and very strong underwriting. We have launched a senior loan ESG strategy. It is an Article 8 fund and UCI Part 2 structure. And we believe this is one of the ways that investors can access the senior loan market. So with that, I'll take a pause and hand it back to you, host.
Thank you very much, Tony, for your presentation.